Well, that's the $1 million question. Actually, to start with, if you look at the message conveyed by financial markets, it's clearly not the one of a sharp slowdown. Risky assets have had a very strong run since the beginning of the year and clearly not reflect any recessionary fears. Still, on a fundamental basis, we can see mixed signals. There is a hard divergence between the hard data on the one hand and the soft data, which are most based on typically surveys. The first one are still remaining very firm, actually, a solid US economy, while the soft data clearly are mixed and point to some disappointment going forward. For example, amongst these soft data, the PMIs, which are probably the most reliable indicators in terms of looking at where the economy is heading. We also see this divergence actually between the manufacturing sector, with indices which are clearly pointing to a recessionary scenario, while the service sector remains quite resilient, we must say. And this is a bit of a surprise actually in this cycle. But if you look historically, it's been the case quite often, maybe not to such an extent, but usually the service sector is also following the manufacturing sector on the downside and reaches also a territory which is below 50, which clearly expresses some contraction of the economy. Clearly this cycle is atypical with, amongst other factors, some counter-cyclical forces coming notably from the post-COVID reopening, with a normalization of supply chains, and this has induced some downside pressure on inflation, and at the same time has acted as a stimulus for US growth. But from now on, what could sustain further the economy is clearly more questionable. We are in an environment where financial conditions have been tightened quite aggressively, and in this exercise, the central bank, of course, play a central role. They need to slow down the demand side of the equation if they want to have a chance to curb inflationary pressures. Speaking about central bank, the Fed, at its last June meeting, decided to pause, not to hike interest rates anymore, after a quite strong hiking cycle of 500 basis points, in order to better assess the effects of these past tightenings and to focus on forthcoming economic indicators. But at the same time, they kept a quite hawkish tone in their comments and also warned for future rate hikes to come probably. We believe this skipped meeting is probably a mistake. To give you an illustration, if you focus on the CEP figures, so the summary of economic projection from Fed officials, if you compare them to March, actually in June now, they forecast by the end of the year higher inflation, higher core inflation, higher growth, a lower unemployment rate, and they decide to skip. Another illustration, if you put these forecasts into a Taylor rule model, which is an equilibrium model for interest rates, you end up with Fed funds level of 6.3%, which is still 100 basis points above the current level. We fear the risks for US inflation is to rise again in the second part of this year. This will reinforce the hawkishness of the Fed, leading to more rate hikes until something breaks, typically what we call a policy mistake that will trigger a recession in the US. It's definitely not a good environment for risky assets. This will not happen tomorrow, but actually to have a chance to win the fight against inflation, monetary authorities have to engineer a strong enough softening of the economy, especially in order to reach the 2% inflation target that they want. And this very likely looks like more hard than a soft landing. This is actually what happened during the 7 out of the 8 last hiking cycle in the US. But this is, in a way, relatively good news as well, because this would mark the beginning of a new economic cycle with the bull market that goes with it.